If I save just one person from wasting a decade of their life messing around with technical analysis, then this video will be worth it. In this video, I'm gonna tell you why I completely stopped looking at price charts. And actually, I haven't for a very long time now. That's right, not even a glance. No price charts, no candlestick charts, no moving averages, MACD, RSI, none of that junk. And I still beat the market every year. And that's without staring at price charts on my computer screen, without feeling miserable or hopeless about my financial future on a regular basis after a day of losing money. I'm growing my wealth faster than anyone I know, and I'm doing it in a way that's systematic and strategic and safe. Does that sound nice? If it does, be sure to stick around to the end of this video because that's really where the big epiphany is gonna happen. So I did a poll recently on my channel asking you if you had to choose only one tool for picking stocks, which would you choose? And you can't even look at the other. Historical price charts or financial statements. And I was actually surprised because in spite of all the content that I put out there on how to value companies and how to buy stocks when the market has priced them below what they're worth, still 21% of you voted that you would choose historical price charts. And honestly, I don't blame anyone for making that mistake though, because I made that mistake as well. When I was 16, when I first discovered the stock market for the first time, and I thought, wow, this is incredible. I can actually use this thing called the stock market to make money by sitting there at my computer. Well, I immediately dived in and I started learning as much as I could. And unfortunately for me, that meant learning technical analysis. That's the path I took. I never even realized that there was this whole other path that all the billionaire investors had been following. Oops. So I followed the wrong path too, and so it's not your fault. No matter where you look when it comes to stocks, it's always the price chart right there front and center, and it gets all the emphasis as if it must be the most important thing to look at, but it's not. Now, by the way, if you're feeling skeptical right now watching this, I'd encourage you to keep an open mind for just a few minutes, because basically, worst case scenario is you waste a couple minutes learning about how someone else is modeling after the billionaires of the world. But best case scenario, you save yourself a decade of trial and error messing around with technical analysis. And if you're at a place in life where you're considering diving into learning about technical analysis, like I did back when I was 16, or maybe you already know all about technical analysis and you're struggling to be profitable and you're trying to find out if there's a better way to do this whole wealth building thing in a better and more strategic way. Wherever you are, this video is for you. So let's jump right into it. We'll talk about the main differences between technical analysis and fundamental analysis, starting with talking about technical analysis. Now bear with me because I'm going to explain this in a way that you've probably actually never heard before. So technical analysis, and this part you'll have heard before, is the act of looking at historical price action in order to make predictions about what the price will do next. Someone doing technical analysis will usually look at something called a candlestick chart. In a candlestick chart, each candle represents a period of time. So if you're looking at an hourly chart, each candle represents an hour of time. If you're looking at a daily chart, each candle represents one day. And sometimes there will be these extra indicators that get added onto the chart as well. The MACD and the RSI indicator are two of the more popular ones, and I don't really need to explain what they are because they're worthless once you realize what you're about to learn. Ultimately, technical analysis completely, utterly, and entirely focuses on price. Price action is everything. There's nothing else. Even those extra indicators that you can add to your price chart are just derived using a formula which uses historical price data. And so when a technical analyst is looking at a price chart, whether it's a plain old candlestick chart with nothing else on it, or whether it's got a bunch of other indicators added onto it as well, what they're doing when they're looking at it, whether they realize it or not, is they're looking at it and they're thinking this: what does everyone else currently looking at this exact same price chart, aka what does the market think is going to happen next based on what they're seeing? And also, even more important, what does everyone else that's currently looking at this price chart believe that everyone else is thinking about it and what they think will happen next? Listen, when everyone is selling, the price will go down, and when everyone is buying, the price will go up. So if you can predict what everyone else is going to do, then you're golden. Now check it out though. Using technical analysis is a lot like the game of poker. There are many levels. For those not familiar with poker, the very basics of poker is that there's different hands that you can have, and at the end of the round, whoever has the best hand wins. That's level 1. So on this first level, you know what your hand is and you know what your odds of winning are. On the second level, you know what you have in your hand and you have an idea of what your opponents have in their hand as well. And then you play according to that. On the third level, you know what you have in your hand, you have an idea of what your opponents have in their hand, and you have an idea of what your opponent thinks that you have in your hand, and you play according to that. The fourth level is another step further. It's knowing what you have, it's having an idea of what your opponent has, it's having an idea of what they think you have, and it's about having an idea about what they think you think that they have, and then playing according to that. And that's not even where it ends. The very best poker players out there just figure out which level their opponents are playing at and then just play one level higher than that. Technical analysis is the exact same thing. There's so many levels. And that's why making money with it isn't just easy peasy the way you think it should be. Anyone telling you they're making easy money with technical analysis is either lying or they've only been playing the game for a very short period of time. To pull it off for many years consistently takes basically champion poker player level mastery and a bunch of luck on top of that. People new to it and just getting into technical analysis don't realize this, but that's the game they're getting themselves into. And it's hardly taught like this by any of the trading gurus out there. It's gonna take a lot of brain power to be successful in it, and it's gonna take a lot of time and dedication, and it's gonna be very difficult and almost near impossible. What I'm gonna tell you about next though, on the other hand, is much more simple and much more easy. Yes, you will have to devote some time to getting it right, but it's gonna be really rewarding. And the other thing is it's gonna be a lot less emotionally exhausting. So if technical analysis focuses on the price, fundamental analysis does the opposite. Price is basically the very last consideration. Instead, with fundamental analysis, what's focused on is the underlying company of the stock, and specifically what it's worth. Another way to put that is just simply, what is its value? What is the value of the company? What is the company worth? Now I should point out, by the way, right now that what I'm talking about here doesn't apply for things like crypto or Forex or any other asset you could invest in, but does not produce any cash. This only works for assets that produce cash. Businesses, aka stocks, produce cash. And so that's why I specialize and focus on stocks. If you're trying to get rich trading crypto or trading Nike shoes or Beanie Babies or Pokemon cards, this video isn't for you, I'm sorry. Your guess is pretty much as good as mine when it comes to those things and what they're worth. But a business, on the other hand, what is the value of a business? What is a business worth? Well, that's what fundamental analysis attempts to figure out. In this approach, the fundamental analyst approaches this whole thing from a whole other perspective. What they do, instead of thinking about shares of stock and the price per share, and what that price per share has been in the past. Instead, they step back and they look at it as if they're buying the entire company. And you'll understand why that makes sense in a second. They think to themselves, if I were to buy this entire company, what would be a reasonable price to pay? And also, what would be my return on my investment if I bought this entire company at that price? And only then do they finally look at the price it's actually trading for. What they look at is called the market cap. So for example, if our fundamental analyst concludes that the company he's looking at is worth $100 million and that buying it for $100 million would provide a 10% annual return, and then they go ahead and look and see that the company is currently trading at a market cap of $50 million, well, it means that they've either found a undervalued stock or it means they did something wrong in their valuation work. For those not familiar, a company's market cap is essentially its price tag. Market cap is just the share price multiplied by the number of shares outstanding. And shares outstanding is how many shares that the company's ownership has been divided up into. So a company's market cap is essentially what the market thinks the company is worth. It's how much you'd have to pay to own all of the shares at their current price, and therefore when you own all of the shares, you'd own 100% of the company. Now when I say the market, by the way, all I mean is the people. The market is just the people who do the buying and selling. Stock prices are set by the collective of everyone doing the buying and selling. And everyone ends up influencing each other, especially those people that are staring at the price charts and trying to figure out what everyone else is thinking, what everyone else is gonna do. They're influencing each other. So everyone that's doing the buying and selling, they're the market. If you buy and sell stocks, you're the market. You and all your peers, everyone collectively is the market. Now you might be asking, why would the market underprice a stock? You might be thinking, that can't be realistic. Why would the market underprice a stock? Why would the market price a stock for half of what it's worth and therefore provide you with the opportunity to buy shares of that stock for 50 cents on the dollar? That can't be possible, right? But that's exactly what I'm telling you. It is possible, and that is just exactly how it works. Typically, by the way, the most active people in the market are the ones that are the least focused on the fundamentals. The most active people are the ones looking at the charts and making their decisions based on the technical analysis. So what you end up getting is the people who are the least focused on the fundamentals are the ones that are actually setting the prices most of the time. Now you kind of have to either believe that the market is always right and that a stock's price always perfectly represents what it's worth, or you have to believe that the market is sometimes wrong about what a stock is worth and that the market isn't always perfectly efficient. You have to believe one or the other. And if you believe that the market isn't always efficient, then you kind of have to agree that the market can be wrong in both ways. The market can sometimes overvalue stocks, and it can sometimes undervalue them as well. Now, most of the time, especially right now, recently, as I'm filming this video, the market tends to overvalue stocks, but sometimes it still undervalues them too. Now, if you're skeptical about what I'm talking about here, I would check out this video here. It's one of the original videos I made on this channel. It's about chapter 8 of the Intelligent Investor book by Warren Buffett's teacher, Benjamin Graham, and it's all about markets and why they're not efficient. And if you're watching this and realizing, wait a sec, yeah, the markets aren't efficient, and sometimes I guess that means that stocks can be priced below what they're worth, then I would check out this video right here on the basics of how to value a company. Now, for some companies, figuring out what they're worth will be pretty much impossible, and so you actually never end up knowing if they're currently undervalued by the market or not. But that's fine, because you don't need to be able to value every company. Because for other companies, it's actually much easier to figure out what they're worth. Let me tell you, there are companies currently trading at prices which can provide you annual returns that will beat the market. Annual returns of 10, 12, 15, 16, 18, 20% can be found right now. It's just not quite as easy to find them as it has been before, but that doesn't mean you shouldn't try. Really, you just need to search them out and find them. And unfortunately, there's really not any great alternatives. You could invest in real estate, perhaps, but I personally think I'll do much better in stocks. Or you can start your own business, but again, I don't know if that's worth it. I personally prefer to just buy already established businesses that are great businesses and then just buy them when they're trading at sensible prices. To me, that's much easier, and I get much more excited about that than I do about starting my own business. So bottom line to the big question of why did I completely stop looking at price charts? Well, it's because they tell me absolutely nothing about what a company is worth. They only tell you what other people think it's worth and what they've thought it's worth in the past. It's a distraction. Warren Buffett himself says he doesn't look at the price until after he's spent the time figuring out what he thinks it's worth. And he says he does this because he doesn't want to be influenced by that price while he's coming up with his own idea of what he thinks it's worth. Does that make sense? So playing the technical analysis guessing game is kind of a fool's errand once you realize the opportunity that the stock market actually is. The stock market, in my opinion, is kind of the biggest cheat code in life. There's no better way to build wealth and reach financial freedom than basically exploiting the inefficiencies of the stock market. So I would encourage you to take your financial future into your own hands, but please remember that I'm not your financial advisor. I'm just someone that loves business and loves investing, and so my content should not be taken as financial advice.
If you were starting out again today in your early 30s, what would you do differently or the same to replicate your success? In short, Mr. Buffett, how can I make $30 billion?
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old. I would do it exactly the same way if I were doing it in the investment world. I mean, if I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena. And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. I mean, you have to buy businesses or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about. And you can't expect anybody else to do it for you. I mean, people will not tell you about wonderful little investments. It's not the way the investment business is set up. You've got to follow your own, you've got to learn what you know and what you don't know, and within the arena of what you know, you have to pursue it very vigorously and act on it when you find it. And you can't look around for people to agree with you. You can't look around for people to even know what you're talking about. You have to think for yourself. And if you do, you'll find things.